price trends are the most lucrative periods for trading. Visual trends that appear on a price chart are represented by lines which connect trend peaks and valleys and usually form a channel, that is, an upper or lower range bound of a new trend. The upper line of an uptrend channel is called the resistance line, because the price resists breaking this line on the way up. The lower line is called the support line, because this line supports the price from falling under. On the uptrend, the lower line is also a trend line. Trend lines are valid because trading is mostly about psychology. The great majority of traders think of them as support and resistance lines, which enforces their importance as a self-fulfilling prophecy. Remember that it is hard or even impossible to predict events. Once an event triggers a new move, however, people start to jump in, as it is easier to predict that fear and greed are the main motivators in trading. It is highly important to learn how to draw trend lines the right way. I have seen many false drawings of trend lines, which is a sure way to lose money on the market, because your trading decisions will be based on false signals, which inevitably lead to false conclusions. The important thing when evaluating the market situation is to determine as soon as possible whether a price has changed direction and continued to go in a newly established direction, thus starting a new trend. Indeed, you will need to enter a position as soon as a new trend starts to materialize, and the sooner the better. This will ensure you have enough time to profit before a new trend exhausts itself. The newly established trend will go on for some time because traders want to profit from it. The upper trend is valid until there are new higher highs or peaks and higher lows or valleys identifiable on the chart. When the next high on a chart is lower than former high, this is a warning sign that the trend may be near the end. If the next low is lower than former low, this is even stronger confirmation that the trend may be over, meaning that you should close your position. This price formation indicates that sellers have started to be more confident than buyers, which usually means that the uptrend may be over and you should close your position. This can be seen on a chart as the breakout of a trend line. The opposite is valid for a downtrend, which is valid until there are lower lows or valleys appear. When the next low is higher than the former one, this is a signal that the trend may be exhausted. If a lower high is followed by a higher high, this usually means that the trend is over and you should close position. I'd like to emphasize the importance of drawing trend lines the right way. For an uptrend, after the down price has turned upside, always draw a line connecting the first two higher lows. As time goes by, try to connect the first higher low with the next higher low without a line breaking through the other lows. The uptrend is valid until there are new higher lows on a chart. With time you will manage to do this intuitively, but at first you will need to stick to the above mentioned rules. The best way to learn something is to do it repeatedly. Remember, it is extremely important to learn how to properly use trend, support and resistance lines. Once properly set, they will provide you with a lot of useful information which can be used in your trading decisions.